You know your credit report, that thing lenders look at when you apply for a loan, is important. But what is it exactly? Let's focus on the three main U.S. credit bureaus. They collect credit information from your bank, credit unions, credit card issuers, retailers, mortgage lenders, collection agencies, and public court records. All of the information about you from all sources is compiled into a credit report, an electronic file based on your previous and current credit history. Lenders can then access these credit reports to get a better understanding of whether you're a qualified or risky candidate for credit. Credit reports are dynamic. They change when lenders update your information or when new public records about you are posted. These changes can impact your FICO scores. Now, let's look at exactly what the credit report contains. Start with your personal identity information, name, address, and social security number. This information doesn't impact your credit score. However, you can protect against potential identity theft by checking for accuracy. Your reports also contain public records the court collects on bankruptcy. If you've ever had an unpaid bill turned over to a collection agency, that will likely show up on your report too. Information called trade lines form the heart of the report. That's information about your various credit accounts, such as when they were opened, the loan amount, and your current balance and payment history. Creditors typically report this information on a monthly basis. Finally, whenever someone accesses your credit file, an inquiry is reported. There are many types of inquiries, but the FICO scores only consider inquiries resulting from a credit application. All of this information forms the foundation of your FICO scores, a measure of your credit risk used by 90% of the top lenders. Now, FICO isn't a credit bureau, but rather a company founded on scoring credit reports. Working closely with the credit bureaus, FICO creates scores based on the bureau's data. Scores that make it easier for lenders to understand credit reports and determine your credit worthiness. And remember, you can and should review your own credit reports. Monitor them, check them for accuracy, and see what factors are impacting your FICO scores. Why do you need to understand what a FICO score is and how it's used? Because it's the credit score most commonly used by U.S. lenders. Every day, thousands of lenders use it to more accurately understand your credit risk and make more well-informed credit granting decisions. In a nutshell, the FICO score is a number that predicts how likely you are to pay back a loan or other credit obligations in a timely fashion. The FICO scores are calculated from the data in your credit reports housed at the three main credit bureaus. The scores consider information about your payment history, use of available credit, plus other factors. Most of us have FICO scores for each of our credit reports. Of course, if you don't have any recently reported credit history, you won't have a FICO score. FICO scores are dynamic and can change up or down if and when your data at the credit bureaus changes. And they're calculated in real time, so they're current as of the time you or a lender requests them. FICO scores generally range from 300 to 850. The higher the score, the lower the risk for the lender. Ultimately, your FICO scores are in your hands because it's based on your credit habits as captured in your credit report. Your FICO scores do not determine whether you're approved for credit or what interest rate is assigned. That's up to the lender. But it does help the lender make that credit granting decision. So why do FICO scores matter to you? First, it makes the lending process faster and more fair. It provides you with more credit choices at competitive rates, and you'll get faster answers from lenders since the scores streamline the application process. And it applies the same set of standards to all borrowers. Finally, as you prepare to apply for a loan and view your own FICO scores, you can see what a lender sees. Your credit history all rolled up in a 3-digit number that predicts your likelihood to pay your bills on time. You know your FICO scores are important, as they are the credit scores used by 90% of the top lenders. FICO Score 8 is the most predictive and most recent FICO Score version most widely used by lenders. This is the version on which you should primarily focus. That's why it is prominently featured when you get your FICO scores. Along with FICO Score 8, you'll get additional FICO Score versions with each credit report you obtain with your FICO Score product. Included are FICO Score versions that may be used by some lenders who have yet to switch to FICO Score 8, versions predominantly used in mortgage lending decisions, as well as industry-specific auto and bank card versions that have a slightly wider 250 to 900 score range. It's likely that your scores from different versions will not be the same. However, as the versions are all built on a similar foundation, generally speaking, many people will see that the scores are relatively close to each other across the versions. For example, if you score high on a FICO Score 8 base version, you'll likely score high on a FICO Auto Score 8. It's important to focus on the FICO Score version that is most relevant to you given your near-term credit needs. If you're buying a house or refinancing your mortgage, check the base FICO Score versions most commonly used in mortgage lending. If you're buying a car, look at your FICO Auto Scores, as the majority of auto loan applications are reviewed using this industry-specific version. Applying for a new credit card, check out your FICO Bank Card Scores or base FICO Scores. If you're seeking other types of credit, such as a personal loan, student loan, retail credit, or other types of credit, generally focus on your FICO Score 8 version or other FICO Score base versions. The good news is, regardless of FICO Score version, all FICO scores consider factors such as whether you pay your bills on time, amount of your credit debt, and how often you apply for credit. Consider this. If you were lending your own money to a friend, you'd want to make sure you'll get paid back. You'd probably wonder, have they paid their past debts on time? How much debt do they already have? And who else are they approaching for the loan? FICO scores help lenders answer these same questions every day, but through a mathematical formula that makes the lending decisions faster, safer, and more fair. So, it's really important you understand how your credit activities and behaviors are considered when calculating FICO scores. FICO scores focus on 5 key predictive categories: your payment history, how much you owe, how long you've had credit, if you've recently sought new credit, and the types of credit you've used. Clearly, your payment history and level of debt substantially drive your FICO scores. Have you missed payments? If so, how often, how recently, and how late were they? Have you had debts turned over to a collection agency? Do you have foreclosures, or have you filed for bankruptcy? The more recent, frequent, and severe the reported negative items are, the bigger the impact on your scores. Next, there's the debt you're already carrying. Are your credit cards nearly maxed out? How many accounts with balances do you have? How much of your available credit is being used? If you're overextended, you're more likely to miss future payments. Then there's how long you've had established credit, from your oldest to your newest account, and an average age of all your accounts. FICO scores also consider how often you've actively applied for credit in the past year. Rate shopping is accommodated for, and promotional, insurance, and employment inquiries don't count against you. Whenever you apply for credit, there's a good chance your lender is using FICO scores to help make that approval decision. So it's important that you understand your FICO scores, because it could help you know whether you qualify for low rates on your next loan. Know your FICO scores. Understand what goes into your scores. Did you know it's estimated that over 40% of US consumers have FICO scores of 740 or greater? That's a lot of people who likely have access to more credit options and at better rates. The good news is having access to more affordable credit is an achievable goal for anyone. However, achieving one's financial health can take both time and perseverance, and a longer-term focus. Start by accessing and evaluating your FICO scores. They'll help you understand how lenders evaluate your credit risk. Because the credit report is the foundation of your FICO scores, make sure the reported data is accurate. If you see errors, follow the dispute instructions to get those errors resolved. Then educate yourself about credit score dynamics. Paying bills on time has the greatest impact on a FICO score. If necessary, set up automatic alerts as payment reminders. Missed payments, especially recently missed payments, can substantially impact a FICO score, so it's important to get and stay current. Keep credit card balances well below credit limits. Pay off debt, don't just move it around. When shopping for a home, auto, or student loan, do it over a short period so the inquiries get treated as a single search for credit. This tactic is often known as rate shopping. And avoid short-term gimmicks, such as closing unused accounts or opening new ones just to increase available credit. These tactics may actually have the opposite effect of what was intended. In other words, only apply for new credit accounts when needed. Then continue to check your FICO scores over time to see how your financial decisions impact your scores. Learn from the information you'll receive explaining the top reasons impacting your FICO scores and change your behaviors accordingly. And finally, keep checking your progress. FICO scores are dynamic and change as the underlying bureau data changes. The bottom line is this: understanding your FICO scores over time and adjusting your financial behavior is a vital part of your financial health and can help you get the credit you want at more favorable rates. So, how do the 90% of top lenders in the US use FICO scores? They use them in a number of ways that matter to you. Received a pre-approved credit card offer recently? Well, there's a good chance your FICO scores were used to identify you as a qualified prospect. Applied for credit recently? A FICO score was likely used in the approval decision process. Have you recently received a credit line increase on your credit card? Well, most lenders periodically get refreshed FICO scores on their customers. Your credit line increase was likely a reward for your ongoing credit health. FICO scores help lenders understand if you are likely to pay as agreed and if they should extend you credit. And lenders often use FICO scores to set credit terms, such as the amount of credit they'll give you or at what interest rate. Now, as important as they are, your FICO scores aren't always the only information lenders use. Along with FICO scores, they may also consider your income, employment history, the value of your collateral, such as your home or car, or any existing relationships the lender has with you. Keep in mind too that for most credit evaluations, such as a credit card application, lenders will use a FICO score from just one of the 3 credit bureaus. However, the applicant typically doesn't know which of the 3 credit bureaus the lender will use. But for a mortgage or a home equity loan, it's a little different. Lenders will usually take into account a FICO score from each of the 3 credit bureaus on all applicants. Now, that's a really good reason to monitor your FICO scores. So, the bottom line is this: higher FICO scores can make a substantial difference in what people, like you, pay for a loan. So, be sure to monitor yours so you can understand how lenders see you and understand your financial health. So you're thinking about getting a new car, or maybe purchasing the home of your dreams. You'll need financing. So you want to first check your credit scores to make sure your credit is in tip-top shape. So which credit scores should you look at? You see a lot of advertisements about different credit scores. Some are free, some are on different scales, and all of them claim to be the only credit score you need. It can be really confusing. But it doesn't have to be. Simply focus on your FICO scores, because 90% of top lenders use FICO scores to make lending decisions, not those other scores. So what do you need to know about these other scores? You shouldn't rely on them to estimate your terms and rates. Most lenders simply don't use them in lending decisions. So they may confuse you into thinking you qualify for better rates than you actually do. Keep in mind you most likely have multiple FICO scores based on your credit reports housed at the credit bureaus: Equifax, Experian, and TransUnion. Each score could be different, oftentimes as the information about you at each bureau can vary. If the underlying data is the same, your scores will likely be very close to one another. If it's different, your scores may be different. So if there's FICO scores at all 3 bureaus, which one matters most? Well, they're equally important for a very simple reason. You may not know which credit bureau your lender will access when evaluating your credit application. They may access 1, 2, or all 3 in their credit decision process. So empower yourself. Focus on regularly monitoring your FICO scores, the scores used by most lenders, the credit scores that matter.